Hello, I'm Heather Osborn, Manager of Financial Planning at Baird. If 2020 reminded us of anything, it's that life changes. And while we don't know what changes might lie ahead, what we do know is that financial planning can allow us all to operate from a position of strength and resilience, no matter what changes might lie ahead. To help you navigate into 2021, two of our colleagues from Strategas are going to offer their expert insights into the markets, economy, and fiscal policy. And then we'll be back with Tax and Estate Planning Manager Scott Grenier to narrow the focus to you and your finances. Scott and I will discuss planning strategies that can help you take advantage of or mitigate the impact of developments that might affect your plans into the year ahead.
Hi, everyone. I'm Jason Schretter, Chairman of Strategas, and I wanted to introduce to you today a couple of investment ideas that we think will be useful to you as we navigate the shoals of 2021. I think the first one would really the first theme, I think, is this idea that you'll probably have somewhat weaker index returns but a stronger economy. And I know it might feel somewhat uncomfortable. I think we get a question a lot about what is the disconnect between the market and the economy. But the idea largely is that money growth acts as somewhat of a counter-cyclical force on risk assets and stocks in particular. And that is to say that if money growth is growing very rapidly, but the economy is weak, it actually tends to be quite good for risk assets and for stocks. And I think in many ways that was the case last year. As you know, the Fed's balance sheet increased by 70% from $4 trillion to $7 trillion. M2 is growing at about 24%. And as we saw, a lot of that excess liquidity found its way into stock prices, NASDAQ, the S&P 500, while there was really few other alternatives in the fixed income market. In our opinion, this year is going to be a bit different because you not only do you have more fiscal stimulus, you have another $900 billion that was just passed a couple of weeks ago, which will be dumped into the economy in the first 4 or 5 months of the year. We also have a vaccine. So I think the combination of still easy monetary policy, new fiscal policy, and reopening, all of those things should pave the way for a much stronger economy. The second theme we were talking about is it's consistent with that idea. And it largely hinges on the idea that you'll have higher long-term interest rates. It's just more of a bias towards small caps, value, and international stocks, as opposed to large caps, growth, and domestic stocks. This is a pretty popular theme to start the year, but I think it's a reasonable one. Just because it's popular doesn't mean it's necessarily completely priced in. Our own opinion is that the combination of factors that I talked about with regard to the first theme is going to lead to higher long-term interest rates. And that will provide some, I would say, headwinds for the technology sector in particular. The technology sector, many of the stocks are being priced as if the terminal values are not being discounted or being discounted by negative real interest rates. I don't think that's going to be possible this year if long-term interest rates rise. So we would be more inclined to be market weight the technology. On the other hand, we like the fact that financials and energy will probably benefit the financials case from a steeper yield curve, and in energy's case, a much stronger demand picture for energy, for oil in 2021. I would say with regard to energy, I think the new administration also obviously is very focused on climate change and is going to likely limit the ability of energy companies to drill more. It's going to be a little bit more difficult. So you'll have a situation where you have some supply constraints, but at the same time, we think demand will go up meaningfully. As far as the financials are concerned, they should benefit from a steeper yield curve. And the Lord only knows where the 10-year Treasury yield will rise. But I would just say that the current levels are inconsistent with our forecast for economic growth this year, which for the U.S. we think will be more like 4 to 5% at a minimum in real terms, plus another 1 or 2 for inflation. As far as international is concerned, I do think all of that spending and all that liquidity does come with a price, and the price might be a weaker dollar. That should bode well for international stocks and certain emerging markets. Certainly, the emerging markets that are commodity exporters should do a bit better. So we think that's an interesting place to be. And I would also say that small caps generally tend to do well at the start of an economic cycle. And so large caps are quite expensive. There's been a lot of money moving into them because a lot of people are moving into the S&P 500. But we think there are some real opportunities in small caps because this will also probably be a pretty strong year for merger and acquisition activity with interest rates still relatively low and large companies very much flush with cash. So all those things, in our opinion, should pave the way for a better year for small caps, for value, and for international. We'll have to amend our forecasts as the facts change this year. But this is the way we're seeing the world right now. Hope that was helpful. Thank you.
Hi, I'm Dan Clifton, Head of Policy Research at Strategas Securities. 2020 was an unprecedented year for politics and public policy. We had 4 very unusual and super transformational events happen last year that when we went back over 100 years, we can never find 4 of these events happening in one year. Those were a recession, a pandemic, mass protests, and a presidential election all happening in the same year. But we start 2021 with a new president and a Democratic control of the House and Senate. We think the big issues that investors need to be focused on as we come into 2021 are going to be on the stimulus and tax planning side. We envision the Biden administration moving forward on a 2-front stimulus package. The first, which will be done in early 2021, will be largely focused on income replacement. This is a continuation of safety net programs designed to get the American public and American businesses through the COVID-19 until enough Americans can be vaccinated that we can have a full reopening. As part of that first plan, we think that we're going to see a stimulus package focused in 4 areas. First, more direct aid for American consumers, somewhere in the range of $1,400 per person, making under $75,000 of income, or a married couple of $150,000 of income. This will supplement the $600 check that was sent out earlier this year. The second would be aid to state and local governments. While there's a wide range of estimates of how much state and local governments can get, the Democrats believe that state and local governments need more aid to prevent layoffs of public employee workers and are likely to get at least $200 billion of aid to state and local governments included in the package. The third would be an extension and possibly enhancement of unemployment insurance to ensure that workers who are not able to come back to work yet still have enough income, and in most cases, income greater than what their salary was before they were laid off. And then fourth would be an expansion of the earned income tax credit, which provides income support to working Americans who have a job through a negative income tax. Those are the 4 ideas that are likely going to get the most support in addition to more aid for vaccine distribution. Once we get past that, sometime maybe by the end of February, then you'll start to see pushes for a larger, when I say larger, I'm talking trillions of dollars of more stimulus as part of President-elect Biden's Build Back Better program, which seeks to make investments in climate change, infrastructure, healthcare, education, and possibly more money for state and local governments. Now, we are less confident of the idea that we're going to get trillions of new infrastructure and climate change spending later this year because you'll have a faster economic recovery from the reopening, you'll have more vaccinations, and Congress already put $2 trillion of economic stimulus into the economy in 2021. So the dollar amount and the timing is less certain than that first package, but one that I think will be a continued focus of the Democrats. Now, what does all this mean? What all this means is that as you start to discount more stimulus, you're likely going to see higher interest rates. The Federal Reserve is saying that they're going to keep the short-term interest rates near zero while allowing for inflation to exceed 2%. Meanwhile, Congress is throwing massive fiscal policy stimulus down. That should lead to a steepening of the yield curve and expectations of higher economic growth as we go through the year. Additionally, further economic stimulus and more deficits usually translates into a weaker dollar. The US dollar is led by the twin deficits, meaning the budget deficit, the trade deficit, usually leads the dollar by about 2 years. And as we increase the size of the federal budget deficit, that should lead to a weakening of the US dollar, all else being equal. And so that is a pretty broad fiscal policy that is likely to happen in 2 steps. We call it candy and spinach. The first package in February is likely to have a lot of candy, a lot of spending. The second package is also likely to have a lot more candy, front-loaded, with some spinach on the back end, which includes our meaning of some tax increases. This is not a guarantee. Raising taxes in a soft economic environment is never easy to do, but it is one that is possible because of the budget rules that are in place and the need for greater fiscal spending from the Democratic policy priorities. We look forward to continuing this discussion through 2021. Thank you.
When looking at the ever-changing landscapes in the market and the economy, there will be times when changes will be in your favor and others when they are not. However, it's important to stay focused on what your long-term objectives are and how we can use financial planning to stay focused on what your long-term goals are. There are several financial planning areas we recommend that you consult with your advisor on.
One of the most intriguing areas of planning in 2021 will be income tax planning. With a presidential election behind us, there are numerous tax law changes that are in consideration. The ones we are most focused on at this time are changes to the highest marginal tax rate of our ordinary progressive income tax structure, a significant change to long-term capital gains and qualified dividends at the highest level. In addition, there's also the possibility of a new Social Security tax for high wage earners. In addition to the potential changes in the federal income tax system, we're also monitoring the potential for changes to the wealth transfer tax system. Currently, an individual can transfer up to $11.7 million to other individuals, whereas a married couple can transfer $23.4 million to other individuals, either during lifetime or at death, without paying a gift or estate tax. A reduction in the federal estate tax exemption would mean more planning for taxpayers during their lifetime to minimize this potential tax while maximizing wealth transfer to their heirs. Maybe as significant, but much less discussed, are the changes to the IRA beneficiaries rules created under the Secure Act, which was effective January 1, 2020. These new rules significantly limit the ability for an IRA beneficiary to defer the income tax recognition of an IRA, while also placing limitations on the ability for the IRA beneficiary to maintain the money inside the IRA on a tax-deferred basis. The end result? A greater amount of taxes being paid by the IRA beneficiary over a shorter period of time. Now, more than ever, IRA owners must consider whether to convert to a Roth IRA for tax-free distributions by the heirs in the future, or leaving a traditional IRA to their heirs to pay the taxes later. We're preparing for changes to the life expectancy tables used for IRA owners and IRA beneficiaries. These new life expectancy tables go into effect January 1st of 2022 and will result in a lowering of the required minimum distribution percentage on a going forward basis. Income tax laws and wealth transfer laws are ever changing. By creating a collaborative partnership, your Baird financial advisor, along with your trusted advisors, can create a customized, tailored approach to help you achieve your lifetime and wealth transfer goals in a tax-efficient manner.
Planning for retirement is a common conversation we're having with clients given the pandemic, especially because it's caused so many to initiate retirement sooner than anticipated. And this is a trend that will likely continue for some time. If retirement planning is an important consideration for you, we suggest you consider the following in the new year. Review your income and expenses. An income and expense review will entail the following. First, make a list of your earned income. This would include your wages, salary, bonuses, and/or commissions. Secondly, take note of any current or future sources of guaranteed sources of income, such as pensions or Social Security. And then third, take note of any other income like real estate, business, or trust income and how it might parlay into your overall tax planning situation. And then lastly, review your portfolio. By reviewing all of these income elements, we'll be able to create the best strategy for your overall retirement plan. Evaluate your cash flow, expenses, and liquidity needs for the year. Establish a spending plan by breaking down your planned expenses into the following categories: your essentials, your lifestyle expenses that would include the things that you love to do, like traveling, golfing, boating, and also build in a cushion for the unforeseen, either for emergency or opportunity. And then also any legacy gifts that might be important to you, like gifts to children or grandchildren or any other charitable inclination or cause that you might have for the year. And then formulate a plan to address any liabilities that you might want to pay down. And make sure to protect your credit. Check your credit and establish a credit monitoring service. And if you happen to be further out from retirement planning, we suggest the following. First off, establish your savings goals for the year. Establish an emergency reserve with 6 to 12 months of your fixed expenses. And then secondly, make sure you've got your targeted savings plan nailed down. Financial planning standards recommend 10 to 12% of your income. Utilizing digital tools like our 360 Wealth and Planning can help give your financial advisor a clear view into your finances. The common theme across all of these financial planning strategies is to have a conversation with your financial advisor. Planning and staying connected with your financial advisor will help you overcome change, whether it's caused by external forces or personal circumstance. We've noticed that our clients with a financial plan are much more confident in the future and their overall outlook, regardless of what's happening in the markets and the economy. We want you to feel empowered to take control of your financial situation by engaging with your advisor on the financial planning strategies we've covered: tax planning and mitigation, estate and legacy planning, and retirement planning and overall financial goal setting. Thank you, and we look forward to working with you.